Hey everyone. So one day the market is just in a total free fall, right? Everyone's panicking about a widening war. And then literally the next day, it just rockets back up. If you got whiplash just watching the screens, believe me, you are not alone. So let's get into it and figure out what really happened here. So this is the big question we're tackling. On March 3rd, the market absolutely tanked on some really scary headlines coming out of the Middle East. But then on March 4th, bam, a huge comeback. So was this because the economy suddenly got way stronger? Or did all the global risks just magically vanish overnight? Well, the short answer is not really. And look, here's the most important takeaway right up front. That powerful rally we all saw, it wasn't about some new fundamental shift in the economy. Nope, it was simply the market correcting its own emotional overreaction from the day before. You can almost think of it like someone just hit the rewind button on pure, unfiltered panic. To really get this, I want you to picture a rubber band, okay? The day before that big rally, fear grabbed a hold of that rubber band and just stretched it, and stretched it, and stretched it way past its natural shape. That stretching, that was the panic sell-off in action. You know, analysts actually have a name for this kind of thing. They call it Cis-1 selling. It's basically a fancy term for your brain's emotional gut reaction kicking into overdrive. When news broke about the escalating conflict in the Middle East, investors didn't really stop to think or analyze. They just hit the sell button. That's Cis-1 right there, pure emotion driving the car. And this is exactly what happens next. That collective SYS1 fear stretches the market way past any kind of rational point, creating a situation that analysts call being oversold. That rubber band we talked about, it is now stretched so tight it's practically at its breaking point. Basically, everyone who is going to panic and sell has already sold. Okay, so if the market was a super tightly stretched rubber band, what in the world caused it to snap back so violently? Well, the truth is, it didn't take much. All it took was a few little sparks of news on March 4th, and that was enough to let the whole thing fly. And boy, did it snap back. Just take a look at these numbers. The S&P 500, the NASDAQ, the Dow, all green, all looking really strong. I mean, the NASDAQ was up over 1.25%. This wasn't some tiny little bounce. This was a seriously powerful reversal. But again, the cause wasn't nearly as strong as the effect looked. So what were these little sparks? Well, as you can see, there were a couple of bits of solid economic data that gave things a nice foundation. But the real catalyst, the thing that lit the fuse, was that third point, a report, which by the way turned out to be false, that Iran was open to a ceasefire. That was all the excuse the market needed. It just gave traders enough of a reason to say, okay, maybe, just maybe, we overdid it on the pessimism yesterday. And this right here brings us to the very heart of it all. The story of that day wasn't really the good news itself. No, the real story was the market suddenly realizing it had made an emotional mistake, and then rushing to unwind it as fast as possible. Here it is, straight from the market analysis. The rebound was a rewind of SYS1. What does that mean? The very same traders who panic sold the day before suddenly looked at the market and saw a bargain. They realized they'd stretched that rubber band way too far, and they rushed back in to buy, trying to find deals before prices shot back up. This slide just perfectly lays out the two different mindsets. The day of the big drop, that was pure SYS1 thinking. Get out now. But the day of the rebound, that was the logical SYS2 brain kicking back in, asking, hang on a second, was that sell-off a bit of an overreaction? Is there maybe an opportunity here? The market literally just switched from the left column to the right column overnight. Okay, so this is all great to know. But how do we actually use this understanding, right? How do we stay in that calm, logical SYS2 mindset when it feels like everyone else is in a full-blown SYS1 panic? This next part is all about turning this analysis into a real, actionable plan. Think of this checklist as your guide. Number 1, and honestly this is the most important, just stay calm. In a crazy headline-driven panic, the best move is often no move at all. Second, watch the actual data, not rumors. Third, keep an eye on the VIX, that's the market's fear gauge. A reading up near 25 or 30 often signals a true buying opportunity. Fourth, manage your portfolio insurance, but don't go overboard. And finally, number 5, always keep some cash ready. You never ever know if you've caught the absolute bottom. And just as important as what to do is what not to do. Do not sell your long-term investments just because of a scary headline. Do not trade based on rumors. And please do not chase a speculative frenzy, whether it's in crypto or somewhere else, just because it's moving fast. That is just letting that emotional SYS1 brain get back in the driver's seat. So I'll leave you with this question to think about. The market is inevitably going to panic again. Another scary headline is going to come along. And when it does, and you see that rubber band starting to stretch, are you going to be one of the people pulling it even further in a panic? Or are you going to be the one waiting patiently and logically for that inevitable snapback?